William here, the Biz Coach, Credit Repair Boss, back for another video. This is week number 3 in our home ownership journey. And today's topic of discussion is going to be the 4 mistakes that you could be making to damage your credit score and you're not even aware of it. So for those who want to buy a home but don't have the best credit, these mistakes could make the process even that much more difficult. Let's get right into it. All right, guys, so we're back here. We're talking about the 4 mistakes or the 4 things that you could be doing to hurt your credit score during the home buying process and not even know it. So number 1 is accumulating too many inquiries or not being completely honest on loan applications. So you want to be careful during the home purchasing process that you don't go out and go shopping for furniture or shopping for a car or any major purchases. Because if you're using credit or financing for those purchases, you could be accumulating inquiries, hard inquiries, which can damage your credit scores if you're already kind of borderline with your credit scores. And a lot of times car dealerships are notorious for running your credit and hitting you with 10 or 15 inquiries all at one time just to find you a rate or to get you approved for an auto loan. So that's one thing that you could be doing to damage your score and that you're not even aware of it. Banks and financial institutions don't like to see too many inquiries because just like on the dating scene, it makes you look like you're thirsty for credit, or that you're just scrambling or reaching, or that you may be a little too eager. And a lot of times it makes banks and financial institutions a little nervous about lending you or extending credit to you. The second thing that could be damaging your credit score or that you could be doing to hurt your chances of getting a home loan is having a lack of budgeting and a lack of saving. So what you want to do is you want to have some form of system in place recurring or periodically to save, even if it's just 5% or 10% of your income into your savings account. This would be, if you have a 401k, this would even be in addition to that. Because you want to have those funds available if something happens. You're not just scrambling for the money or the funds at the last minute if you do have an emergency. Which leads to number 3, no emergency funds or no insurance. So not having proper health insurance, life insurance, or auto insurance, it could be damaging if you have an emergency or a catastrophe in any one of those areas, because now you're in a position to where you're having to make decisions on whether to pay for your necessities or whether to pay for, your credit card bills or, your auto loans or your home, your rent or things of that nature, which could in turn lower your credit scores if you're not paying those on time. If you do have an emergency, it could damage your credit scores even worse, because now you find yourself in serious debt. And finally, closing old credit card accounts. So closing old credit cards can hurt your scores in 2 ways. First of all, it will reduce your overall length of credit history. So let's just say, for instance, that credit card had been open for, 10 years. That's going to, when you close that account, that's going to shorten your length of credit history, which is going to damage or lower your credit scores. The second thing that it's going to do possibly is lower or increase actually your credit utilization by lowering the amount of available credit that you have. So remember, we want to keep our first goal is to have our credit utilization at the 30% mark, and then eventually we want to get down to the 15 or 10% mark. And your credit utilization is the amount of credit that you're using. That you have, let's say $10,000 in available credit, you want to maintain $3,000 or less, because that's going to be 30%. But if you go in and you close one of those if you close an old credit card, let's say it had a $1,000 limit, now you only have $9,000 of available credit. So that could lower your credit utilization. So those are the 4 things that you want to avoid doing if you are in the home owning process or looking to purchase a home and you do have less than perfect credit, these things could decrease your credit score and possibly disqualify you if your scores are less than perfect. But that's it for this week's video. We'll see you on the next one. Peace.